folks, you better buckle up because we've got quite the storm coming. This is going to be a jam-packed video, and I highly recommend you watch it before tomorrow's market open. Number one, we got to cover the market situation heading into this week. Of course, as you know by now, Iran directly attacked Israel over the weekend in an unprecedented escalation. Israel is already pledging to respond. This will have a very large and direct impact on markets come tomorrow, and I'm going to show you exactly what history suggests is a good trade on this. Number two, we are in the final days before the Bitcoin halving. Meanwhile, the crypto market has been taking a massive dumpito. We'll talk about why, the historical data, and what to expect moving forward. Number three, earnings season meaningfully starts this week. We're going to go into what tickers you need to know about and what the overall expectations are for this Q1 reporting season. Let's get to work. Timestamps down below, and as always, make sure to do your own due diligence on all ideas presented here on the channel. Remember, if you're the one taking the risk, you got to be the one doing the ultimate frisk. Lots of people, they get real frisky without thinking about their risky. Big problemo. Okay, so context here. Heading into this weekend, we were already in the most prolonged dip in the uptrend that we've been in since October 2023. We had a 4-day dip at the beginning of the year, a few red days here and there, but we've been in an overall dip now since the 28th, some 11 trading days. That's a pretty prolonged dip, and while prolonged dip sounds scary, the truth is we're only about 2.67% from all-time highs. So it is a prolonged dip in terms of days and duration, but it's not in terms of actual percentage drop. It's basically just a hiccup, which, as I always like to say for us technical traders, the trend is your friend until the trend bends, and a 2.67% dip is not statistically significant enough to mark a trend bend. A 5% dip is when you can get suspicious. A 10% dip is when you've confirmed a downtrend. However, the question that we're facing right now is this dip here going to turn into something like we saw in July of 2023, where you have this 3-leg down trend after a really solid first 7 months of the year? And that dip back in July was inflation and Fed Reserve related. But at the same time, right after those October 7th attacks and new Middle Eastern conflict escalations, well, you got that last prong down, which took it to cycle lows. So history does suggest that unprecedented escalation in the Middle East does tend to cause legs down in the stock market. And the directional strength heading into Monday was already looking weaker and weaker. Combine that with a particularly hot inflation report last week and Fed toning down rate cut rhetoric, and it's not hard to see even more weakening at a minimum and a bigger test of the current direction that we're in. Now, if you go over to this Middle East situation, Iran, of course, launched this unprecedented direct attack on Israel. Of course, Iran and Israel have long been at war by proxy, but a direct attack on Israel is unprecedented, and when you have unprecedented geopolitical risks and developments, well, it's simply going to freak out a lot of money managers who are going to start reallocating their portfolios, their clients' portfolios, into risk-averse assets and hedging, which leads us over to the VIX, VIX. VIX goes up when? Well, when people are buying hedges. When do people buy hedges? Well, when fear and uncertainty are trending up. We actually alerted VIX calls about a month ago as a hedge for ZipTrader options members, and we were a bit early to the game, but the idea at the time was that VIX was getting unrealistically and historically low, which made it due for a breakout, and a breakout has happened. And now VIX is breaking out to its year-to-date highs and prime for a run towards and above $20. And it closed up about 16% on Friday, and that's because those with the big money, the ones with all the connections and the know-how and the big teams of researchers, saw that Iran's threats would come true over the weekend, and so they prepped with hedges, and hedge they did. 16% up is a lot. And the technicals suggest this momentum will continue climbing into the coming week. You look at the last couple of runs here, it ran 19.59% from $12.91 to $15.44, sold off 10% to $13.76, then ran 22.6% to $16.87, sold off 11.61% to $14.91, then ran 29% to $19.21. Following this pattern and the catalyst that we're looking at with this Middle East conflict, well, you can expect VIX to easily run Monday and Tuesday to above 20, and then a sell-off a little later in the week, maybe 5 to 8% before its next cycle upward, which should take it well into the 20s. How do you trade VIX? Well, of course, you can't directly buy VIX, but you can buy options on it or the leveraged version of it, which is UVXY. Moving on, you look over at oil prices. This is the other market that's going to be impacted greatly. Oil futures have already climbed some 27% year over year prior to this escalation. And with this recent news, you can easily expect oil prices to climb well over $100 in the next week or two. Now, if you're worried about the inflation problem, obviously this is going to make things much worse. But what's freaky is you're already seeing a lot of panicking from citizens in these countries. They expect a much larger escalation. If you look at citizens over in Iran, the Times of Israel reports, quote, in Iran's capital, Tehran, Witnesses saw long lines at gas stations early Sunday as people appeared worried about what may come after Iran's retaliatory attack. Now think about this for a second. Citizens in Iran, which is literally overflowing with oil and gas, are lining up to get gas. This is a country where you can get gas for about 10 cents a gallon. 10 cents. So again, why are they lining up? Well, because citizens there are expecting an attack or retaliation that's targeting their oil, their gas infrastructure, similar to what Iran accused Israel of doing over a month ago. And at the same time, you got to realize that Iran controls the Strait of Hormuz, which effectively can allow them the power to block one of the most critical trading routes of oil anywhere in the world. So what's the point here? What's the bigger picture? Well, it's pretty clear that further retaliation is to be expected, and it's going to be waged targeting the oil production and or transportation of oil, which means what? Well, it means a further climbing of oil prices. The trade idea on this, well, I wouldn't trade off oil just yet. And the reason is because we don't yet know exactly what Iran's going to be doing with its production goals and other members of OPEC oil producing countries, what they're going to be targeting in terms of production and exporting. And they tend to like to send signals of what they're going to be doing in the weeks after big attacks like this happen, big escalations happen. So right now, I would play a little bit of a wait and see game with this. Markets are definitely going to be hedging though, which is why I would suggest taking a strong look at VIX as it breaks out higher and higher. Okay, I want to go ahead and move on to the cryptocurrency market and specifically the coin of Bit. So the much awaited Bitcoin halving is expected to start happening sometime at the end of this coming week around the 19th and 20th. Yet at the same time, crypto markets have been taking very aggressively. You can peg this on inflation report fears and the geopolitical crisis, so on and so forth. But bigger picture, Bitcoin does tend to rally before and after halving, and it has indeed already rallied quite a bit before halving. Since October, it's up some 135%, even with recent sell-offs. And we broke into higher highs earlier in the cycle into the mid-70s, right? A little bit lower than the mid-70s, but pretty aggressive breakout. So even if this sells off to the 50s, well, this still fulfills the pattern of running and breaking out before halving. But the question here is really for that second opportunity, which is what is going to happen after the halving. The way to analyze this is by looking at data that breaks down what happened after previous halvings. And in the first cycle after Bitcoin's first halving, well, it rallied 8,447% in the 365 calendar days after that halving. It rallied 290% in the 365 calendar days after the second halving, and Bitcoin ran 559% in the 365 calendar days after the third halving. And if you look at the first, second, and third halving, Bitcoin was either in a sell-off heading into halving, had just started a small pushback, or was just in an attempted recovery. So this current sell-off that we're having right now into halving and perhaps the first week or two after halving isn't incredibly unprecedented. If historical patterns continue, you should see these prices get bought up again. The more it sells off now, the more potential upside you have based on the historical data. Now, how far can you expect Bitcoin prices to go after halving? Well, common sense says that when comparing Bitcoin momentum in past halving to current halving, well, you gotta assume an overall percentage return trend that is downward just because market cap has climbed so much further. Bitcoin is much more mature. In the earlier stages while you're still gearing up to maturity, well, percentage changes are much bigger. Now they're going to be lesser and lesser. For example, this 8,447% return after halving in this first cycle could happen because when Bitcoin was trading at a market cap of 5 or so billion, that was still well below maturity, and it's much easier to run 8,447% from a market cap of 5 or so billion than it would be to run from a market cap of $1 trillion that we're at right now. We're at about 1.3 trillion. If you're at 8,447% return on $1 trillion asset, well, all of a sudden, what's happening? Well, Bitcoin is taking over all of the planets in our solar system, which I know there's some bulls that think that's going to happen. I'm just not there yet. However, a 50 to 100% return, that certainly could happen in this cycle. Now you might say, okay, but Charlie, doesn't the chart a little bit contradict what you just said? After all, it went from 8,447% to 290 and then back up to 559. So it looks like returns are going up again, right, Charlie? Well, no, still as the asset matures and gets bigger and bigger, you can expect overall, not every single time, but overall, the trend of percentage returns to be downward. This time around, expecting a 50 to 100% run after halving is definitely something that's a little bit more on the realistic side. Now, when it comes down to a lot of the smaller cryptocurrencies out there, we made a video last week on a bunch of different cryptocurrencies that you should check out, but those might see massive runs that are many multiples of Bitcoin just because they have a lot farther to run to their own maturity. Okay, moving on, let's go ahead and talk earnings. So earnings season meaningfully starts this week with the financial sector reporting. The big ones, you got the stacks of Goldman and Schwab reporting before open tomorrow. Tuesday, you have Bank of America, United Health Group, Johnson & Johnson, Morgan Stanley, United, JB Hunt. Wednesday, you're getting back into Abbott, US Bancorp. Thursday, TSMC, Nokia, KeyBank, Alaska Airlines, Infosys, Ally, Netflix. Friday, American Express, Regions, and some smaller banks. So let's talk about the expectations going in here, because that's really what matters. So if you look at the evolution of 2024 Q1 growth estimates for the S&P 500, well, estimates were at 5.9% growth in December, 4.7 January 10th, 4.6 January 17th, 4.4% January 24th, 3.5% January 31st, 2.7% February 20th, and now we're at 2.4% as of today. These are the estimates that people had for Q1's reporting. And you can see it went down basically week after week after week after week. And it's well below what the original estimates were for us back in December. So in other words, earnings growth estimates have been dropping like a rock and very, very consistently. And you know what also happened during this time? Well, markets rallied aggressively. So that tells us two things. Number one, markets haven't really cared that much about the growth rates, but also number two, the bar is set very, very low heading into this earnings. Markets have been pumped all year because of rate cut expectations and big growth in the big tech names and excitement in AI. They haven't really been pumping because they think that growth in the S&P 500 earnings overall is going to be super duper strong. They don't think that. Analysts are starting to get to that level where they're like, you know what? I think the S&P 500 is going to be plateauing in terms of earnings. You look at the year-over-year change in net margins, they're expected to go down in Q1 of 2024. In other words, margins are crunching. And this has to do with inflation. Again, we saw huge inflation in 2022 and early 2023 cut into the profit margins of companies. And that's expected to be the case in Q1 2024 as well. And this mimics one of the worst eras in the stock market in the last 20 years. You look at the tech sector, which really is driving markets this year. Well, that's also supposed to take a dip for Q1. Now, there's good and bad news with these expectations. You want the good news or the bad news first? Of course, you want the bad news first. Well, the bad news is that the overall expectations are getting lower and lower and lower. The good news is that since they're getting so low, the bar is set basically at the floor for this earnings season. Markets have already factored in a low standard for earnings, which is nice because when you head into an earnings season where expectations are sky high, well, even if the companies report huge numbers and huge progress, well, the stock price could still sell off quite a bit because people are disappointed because they've just factored in too much. But here you can see very, very clearly the markets have low expectations heading into this earnings season, not high expectations. Anyways, folks, that caps off today's video. Make sure to let us know what you think in the comment section down below. And by the way, I want to invite you to join our absolutely free newsletter email reports that go out every day now. We cover a wide array of time-sensitive and hot stock market topics that I want you to be kept in the loop for. So I'll put that first link down below. Looking forward to having you read our articles. You're going to enjoy them a lot. And again, completely free. Might as well check them out. Have a good one, folks, and we will see you in the next video.